Three, two, one.
Here we go. All right, everybody, welcome to another Wednesday, and it's our Wednesday workshop. My name is Nate Hare. I am the Executive Director at Directed IRA and Directed Trust Company. If you are new to the program, what we do at Directed IRA is we allow people to use their retirement accounts, old IRAs, old 401ks, and invest into things like real estate, promissory notes, investing into alternative investments. You'll hear that term a lot when you join a program of ours. And that's different than investing in things like stocks, bonds, mutual funds, and what those are called traditional investments. So we don't sell investments, however. That's a little different than your guys at Fidelity, where they're going to sell you stocks and sell you bonds. When you have an IRA or a 401k here at Directed, we don't have investments to sell you. So the beautiful part is you get to pick your own investments, and we'll hold anything the IRS allows, including things like real estate. So really excited to bring this information to you guys, because even though we don't sell investments, we can provide you guys education on what is truly possible with a self-directed account. That way you guys can pick good investments and understand what you guys are investing in. So what we're going to cover today is I'm going to first bring on one of our sponsors, but I just want to go over the agenda real quick. After the sponsor comes on, we're going to talk about what you can and cannot buy inside of an IRA, self-directed or otherwise. We're going to talk about the benefits of owning real estate, all different types of real estate in a retirement account, and different strategies on how you can invest in real estate using your retirement funds. And then I'm going to have our very special speaker, Jason Bible, who is an expert in the field. I've known Jason for over a decade now, a phenomenal investor out of the state of Texas. And he's got a lot of good information to share to make you guys think about, is it the right time to buy real estate? Where should I be looking? And should I be buying real estate in my retirement account? So without further ado, let me bring on Dallin Schultz. Dallin, are you with me?
I'm here, Nate.
Dallin, welcome, buddy. You are a local friend of ours with Rev Equity Group. We've had the opportunity to meet and sit down, and you guys have done some phenomenal events here in the state of Arizona. And you guys run a phenomenal company that allows people to use their retirement accounts to invest in alternative assets. So wanted to thank you for coming on. You helped put this workshop together, and kind of tell our audience who you are and what you guys do.
Absolutely. And I appreciate the opportunity. And if this is your first time, or you've been tuning in recently to what Directed IRA is doing, we've used them personally with some of our clients. So if you haven't already had a call with them or connected with them, I definitely encourage you to. It's been an incredible experience for us as the operator, as well as our investors that choose to work with us. So as Nate mentioned, my name is Dallin. I'm the president at Rev Equity Group. And at Rev, we work with busy professionals that are frustrated with their current investment performance, that are looking to invest their hard-earned capital into hard assets, and that are wanting to grow and preserve their wealth in a more predictable manner than what they might be experiencing in the stock market. And what we have found, and what we believe to be the best vehicle to do that as, is apartments. And we provide opportunities for others to invest alongside us, assuming we're aligned on our investing goals. Listen, I'll be the first one to tell you that what we do isn't unique. We're not the only one out there doing this. Our how is a little bit more different in the sense that we offer higher levels of diversification through our investment strategy and model, while ensuring the entire process is easy for our partners. But I'd say what really sets us apart is our why. And we work with other busy professionals that are looking to grow and preserve their wealth. Listen, I'm not a crypto fund guy. I'm not going to sit here and tell you that we can 100x your money in a week, right? But we work with other professionals that are truly looking to grow and preserve their wealth so that they can give more freely and abundantly of their time and resources. And again, we believe apartments are the best vehicle to accomplish this. And our mission is to make the entire process and the education available for all. So again, Nate, appreciate the opportunity of having me on here. And what I'll do for those that are listening, if you are interested, happy to jump on a quick 15-minute call. Listen, I don't know if what we have is a good fit for you, and sometimes it's not, and that's okay. But before we even talk about any opportunities or what we do, we want to make sure the alignment is there. So in the chat box here, I'll go ahead and throw in a link. If you want to take advantage, have a quick 15-minute call, just so we can better connect and get to know each other, happy to do that. And if you're not ready for a call, I invite you to check out our website, and that's investwithrev.com. And we actually just launched our new website yesterday. So
awesome. Well, you guys had a good one to begin with. I haven't seen the new one, but the old one was pretty good.
It's more in line with just who we are.
Okay.
And,
awesome.
And I feel like conveys our message a little bit better. So feel free to check that out. And you all could be our guinea pigs on that website. So if there's any bugs or anything that aren't working properly, we'd be glad to make those changes.
Awesome. Well, thanks, Dallin. Thanks for joining us. And just to remind people online, it's helpful when especially for you self-directed IRA investors, to know kind of where investment opportunities are. One of the beautiful things about self-direction is you get to pick the investments, but one of the hardest things about self-direction is finding investments, especially, as Dallin mentioned, if you're a busy professional. Most of our clients at Directed IRA, truth be told, are not full-time real estate investors. People think, oh, a self-directed IRA to buy real estate, don't you have to be a real estate investor to do that? 85 to 90% of our clients work 9-to-5 jobs. They just find that investing in alternatives has been a better investment vehicle for them, but they're not the ones that are finding the investments. You don't have to have the deals. You just have to have access to deals. And knowing guys like Dallin, knowing guys like Jason, knowing guys that are investment professionals gives you access to deals. And by no means at Directed IRA are we ever going to tell you should invest with this person or that person, but at least knowing where to do some research on your own and do your own due diligence is helpful, especially if you're going to be self-directing and trying to find your own investment. So thanks again, Dallin. We appreciate your time.
And to interject momentarily, anybody that is watching on YouTube, instead of making it live for the Zoom, Dallin's information will be available in the description.
Perfect. Thanks for that, Tristan. So let's jump right into it. And I'm only going to spend, 5-10 minutes just kind of giving an introduction. And this is mostly for people who are new to the program. Hopefully, if you're a recurring attendee, you know who I am already. This program is not about me, but just to give you a little bit of background, my name's Nate Hare. I'm the executive director at Directed IRA. That CISP, that's just a nerdy term saying I know a lot about retirement accounts, self-directed and otherwise. Stands for Certified IRA Services Professional. But my background actually was real estate. Right out of college, I got into real estate. I got into real estate investing 2 years out of college. I spent a lot of years, almost a decade, doing residential mortgages. So that's kind of where I got my start in real estate. I've had my real estate license with Keller Williams. I've done all sorts of things in real estate. And it wasn't until about 2012 that I found out about self-direction and self-directed IRAs and the ability to take retirement accounts to invest in real estate. Now, thankfully, I was relatively young when I found out, but I had the same mentality most of our clients do, which is they think, I wish I would have known about this 10 years prior to finding out about this. I wish I knew I could invest in real estate tax-free in a retirement account. And that's how I felt when I first learned about self-direction. So it's been my mission and my personal goal to teach as many people about self-direction as possible. That way you can find out if it's right for you. If the stock market is a better fit for you, that's fine. But most people don't even realize that they can invest in things like real estate, fix and flips, rental properties, commercial property, land, multifamily apartments. They don't even have a clue that that's even an option in an IRA. And that's what we hope to bring to you guys here on these workshops. So again, my name is Nate Hare. Thanks for joining us today. And just a quick reminder on these programs, the role that Directed IRA plays is different than the role a Fidelity or a Charles Schwab plays. If you have an IRA with those guys, Charles Schwab, Fidelity, just understand the nature of their business. They're licensed securities brokers. They're in the business to sell investments. Doesn't make them bad guys, but that's what they're going to do when you have your IRA with them. When you have your IRA with Directed, we don't have investments to sell you. You basically open an application or open an IRA with us and we say, thanks, tell us when you need it and tell us what you want to invest in. Now, the benefit to doing that is our account agreement with our client says you can invest in anything the IRS allows. And the IRS actually doesn't limit us on what we can invest in. They only tell us we can't invest in 2 things with a retirement account, and that's life insurance contracts and collectibles. Anything else is fair game. So when we put on these workshops or our webinars or our podcasts, remember, we're not giving you investment advice. We're not telling you what you should or you shouldn't invest in. It's all for education purposes only. It's to help you become a better self-directed IRA investor so you can pick good investments for your own self-directed account. So, and why is it so important to talk about retirement accounts? It's the largest source of America's wealth. More people have money in their retirement accounts than their bank accounts. Okay. Today, roughly there's over $30 trillion in retirement accounts. The largest source of American retirement is IRAs. It's no longer 401ks. 401ks used to be the largest bucket of American retirement. Well, once people move jobs or retire, those 401ks, old 401ks, roll into IRAs. So now there's roughly 12 to 13 trillion dollars, that's trillion with a T, in IRAs alone. But most people don't really know what they have as far as assets inside of them. And that's a scary thing when you really think about it. So it's important to think about retirement. I would say if you have a retirement account, you should be asking yourself, what is it invested in? Is it invested in anything that I understand? Is it investing in something that's giving me a stable return? Or is it invested in something that's going to grow not only for myself, but for my heirs down the road? So it's always important to think about retirement accounts because there's just so much money in them. Well, when we talk about what can you own in a retirement account, I already kind of touched on this, but you can own all sorts of things in a retirement account, self-directed or otherwise. Okay. Traditional investments are what most people invest in. Those are stocks, bonds, mutual funds, ETFs, REITs, CDs. And when you have those investments, usually the guys that will facilitate those in an IRA would be your Fidelities or Charles Schwab's. We hold anything outside of that. Okay. The IRS, again, doesn't tell us what we're allowed to invest in. They only tell us what we're not allowed to invest in, but they allow all of these other investments on the right-hand side, which are rental property, fix and flips, commercial property, multifamily, apartments, land, promissory notes. A lot of times promissory notes secured by real estate is a great investment inside of an IRA. Oil and gas, mineral rights, cryptocurrency. Basically, if it's an alternative asset, if it's not something that's publicly traded, we'll hold that in an IRA here at Directed. And most of our clients, truth be told, have IRAs at Directed, and they also have IRAs at Fidelity or one of their brokerage houses. Why? That's a great way to have true diversification when it comes to your retirement assets. You can have as many IRAs as you want. You're not limited to just one IRA. So a lot of our clients, when they're looking to diversify their investment portfolio, they have their stocks at Fidelity and they have their real estate with Directed IRA. So just trying to give some conceptual understanding of what we do here at Directed and what you can do with an IRA. Now, why do we talk about real estate so much? Now, even though you can invest in all sorts of things, let's be honest, real estate's a catchphrase that everybody wants to understand. I want to be a real estate investor. I want to do this. 95% of America's millionaires are real estate investors. A lot of that stuff is true. But when we're talking about real estate, we're not just talking about fee simple real estate. We might be talking about notes secured by real estate, or there's all sorts of creative strategy to take ownership of real estate. It could be investing in a fund like Rev Equity or something where you're invested with other people's money and other people's IRAs to buy something bigger like an apartment building. Most of our clients like to invest passively, but the underlying asset is real estate. So even though we talk a lot about real estate, it doesn't begin and end with just real estate. But let's talk about some of the fundamental differences between real estate and a stock and why people like real estate in their retirement account. Well, one is real estate's tangible. Okay? It's different than a stock. And tangible, what I mean by that is real estate's an asset you can drive by, you can touch it, you can feel it. It's not going to evaporate in the wind. Okay. If it burns to the ground, we have ways to insure our losses on that. It's called homeowners insurance. Okay. And even if we don't get homeowners insurance on the house that we bought in our IRA, there's land underneath that property, and land is about 50% of the value, depending on where you're looking. That's a very different type of asset than a stock in a company. If you invest in the wrong company, publicly traded company, that company can go to zero and you're left with nothing. There's no insurance that will pay you back on losses when you hold paper assets. Now, I'm not calling those paper assets bad, but there's a fundamental difference between real estate and stocks. Most of our clients just like to diversify. So that's one reason people like to have hard assets, tangible assets in a retirement account. It's not because they understand real estate or they're a real estate professional. It's just because they want better diversification in their overall portfolio. The best wealth advisors will not tell you invest in high risk mutual funds, medium risk mutual funds, and low risk mutual funds, and voila, you're well diversified. A good wealth advisor will tell you, we want to have some of your assets in stocks, some of your assets in cash, some of your assets in hard assets. And I'll tell you this much, if you guys didn't know, when you look at the IRAs that are valued above $5 million, all of the IRAs in the United States valued above $5 million, 25% of the assets in those accounts are alternative assets like real estate. When you look at all the IRAs underneath that amount, all the IRAs under $5 million, how much of those assets are alternative assets like real estate? 2%. So the wealthy have known that alternative assets do very well in a retirement account. And even if you look at the numbers recently, alternative assets have outperformed your stocks and bonds in a lot of key areas. So I'll get off my soapbox there, but diversification is one reason people like to look at real estate inside a retirement account. Tax savings. Okay. If you're going to buy and sell real estate, one of the most important lessons I can tell you is it's not about how much money you make. It's about how much money you keep. You keep more profit by investing in real estate or other alternative assets inside of an IRA, inside of a 401k, an HSA, an ESA. These are all tax exempt plans that aren't subject to taxation like me and you are as a tax paying individual. Okay, there's no capital gains tax when you buy and sell real estate inside of an IRA or inside of a 401k. So tax savings is a critical component to self-direction. But when we're talking about real estate or even notes secured by real estate, one of the beautiful parts about, the things that we do here is we allow people to invest in a socially conscious manner. And I've seen this with my own self-directed investments. And I'll let Jason kind of talk about this when he talks about some of his case studies, because I know what Jason has done is he's enabled other people with other people's IRAs to help him rehab property in neighborhoods that need some rehabbing. Real estate investors are really the ones that are out there taking risks to take, underperforming assets and making them performing again. And when you have the opportunity to use your IRA to invest in those types of things, well, not only are you hopefully making a good return on that investment, but you're also making your community a better place to live and play. And I see that every single day with the investments that our clients are making in their self-directed IRAs when they're investing back into our community through real estate offerings or direct purchase of real estate. So that's it that I'm going to talk about when we talk about IRAs. I'm here to answer questions if you want to talk about more IRA stuff as we go. Now I want to bring on Jason Bible. Jason, are you with me?
Yes, I am here, ready to go.
There he is. Jason, I've known you for over a decade, I think now. I regard you as one of the knowledge leaders. I follow all your posts and I've honestly, in the background, I followed a lot of your investments, and I've kind of seen, what you and Rob have done through, doing some single family. You guys have also done some apartments, some small apartments. You guys have done all sorts of stuff. But the thing I really like about it, and I'll let you talk about kind of your background, you're like an economist brain inside of a real estate investor body, because you've got a chart for everything I hear. So
yeah, there's got to have a chart for everything.
Got to have a chart for everything. So thanks for joining us today, Jason. Tell the audience who you are, and I'll let you kick it off. And again, if you guys have questions along the way, type them in the chat box and we'll try to get them as we go. Go ahead, Jason.
Yeah. So my name is Jason Bible. This is a quick agenda. We're going to talk a little about real estate market. May talk a little about Houston, Texas, and Corpus Christi, which is the Gulf Coast, which is where most of our portfolio is. And then investing. And then I'm going to show you guys some case studies. And then we are using Chat GPT for some stuff, and I'm going to show you how to find a market to invest in using that. It's a real quick little thing, and I think you guys will like it. So I always have to give this disclaimer, but we got a zillion attorneys on staff. So just a reminder, I'm not a CPA, attorney, doctor, auto mechanic, IT professional. One of the worst mistakes people make in this business is they pay for advice and then don't use it, which is always kind of weird. So when your CPA tells you to do something, go do that, and any numbers that we present today are just for demonstration purposes only. My background is actually in biotech and healthcare. I did that for about 15 years and started a company called Houston House Buyers back in 2013. And we bought about 100 to 150 houses a year here in Houston, Texas. Most of those were houses that we were flipping. So we'd buy a really big piece of junk, we'd fix it up and put it on the marketplace to sell. I've also been fortunate enough to be an invited presenter at a whole bunch of different events across the country. And thank God COVID's over, because now the conferences are coming back. So this is actually me and the guys at Fortune Builders. That's Daryl Dyke and the Noble Mortgage crew. Again, talking about economics and market forecasting and all that. This is NAREP. This is a Hispanic Association of Realtors here in town. They keep inviting me back. I don't know why. They just love it when I go. So I really love hanging out with this group. They're a ton of fun. I also host a meeting once a month called the Super Investor Meeting. We're one of the sponsors there, and that's all of us on the panel. There's usually 600 to 700 people at this meeting every month. It's kind of a wild meeting. We also do some charity work from time to time, so I got to wear something other than cowboy boots. On the right there, Nate had mentioned syndications and apartments and all that. That's actually our Baytown syndication behind us. It's a 34-unit apartment complex. That's my business partner there in the middle, and those are our other partners on the deal. We also do a radio show and podcast that can be heard in the evenings here in Houston on 1070 AM. But we also have a podcast. You just type in Texas Real Estate Radio. Hopefully if it doesn't come up, there's a problem. But anyway, there's plenty of podcast services out there that host us, and we're also on YouTube. In the middle of COVID, actually right at the end of COVID, I decided to write a book. And the book really goes over the three markets that we experienced pre-COVID, the marketplace during COVID, and then what happened after COVID. It's a great little book. It's not a how to do real estate. Actually, we're writing that one right now, but it's just kind of thoughts and musings of all the crazy stuff in real estate that happened during the real estate, during the COVID market. In the middle of COVID, I bought an office building, and we named it the Texas Real Estate Investment Center. So everyone's talked about doing this around the country, and then we finally just went and did it in the middle of COVID. It is a business incubator for real estate investors. So you walk into our building, there's title companies, insurance companies, inspectors, appraisers, like anybody that has anything to do with real estate has an office in this building. We host like 20 to 30 events a month. It's absolutely crazy. In fact, my gal's texting me now. We got an event today and another one tonight. And so it's a lot of fun. It's almost like a little university, if you will, for real estate. I do some family stuff. This is us running around the countryside. We just got back from a New Year's cruise, I think is what this one was. I've got two sons. They're both Boy Scouts. And trying to get the oldest one to get his Eagle Scout. If you guys know, if you got any Boy Scout parents out there, you know that last milestone is usually the hardest. My oldest one is a sophomore at Clements High School. He plays soccer here. And then my youngest one started picking up guitar. So that's him playing a solo down, actually downtown, if you can believe that. So two really good dudes. We do a ton of travel. Love Isla Mujeres, which is down in Mexico. Always seem to be down in Mexico for whatever reason. I think it's because it's a 2-hour flight. It's cheap and easy. So we have a ton of fun there. But let's get into the presentation. So I said this back in 2017, and everybody laughed at me. I got on a radio show and I said, if you think real estate is expensive now, just wait. Everybody laughed. And nobody's laughing now. So we've been making these predictions for almost 10 years now. And one of the things that we've noticed is our predictions come true typically faster than we expected. And COVID was a real wake-up call. When we were looking at all the data from COVID, everyone's running around going, oh my God, the world's going to end. It's going to crash. And I'm like, that's not what I'm seeing. And I said, in fact, you guys better get ready because this marketplace is about to go absolutely bananas. And that is exactly what happened. If you were down here in Texas, the market appreciated between December 2019 and today over 50%. So, and it didn't matter what city, San Antonio, Austin, Corpus, Dallas, it didn't matter where you were at. Literally every single market appreciated 50%. And it's still appreciating today. And this is one of my favorite quotes from Logan Matamashi on Housing Wire. If you are not following him, I highly recommend you do. He's a big data guy. And he says, look, if you have no faith in your model, everything looks like a crash. So I keep seeing all these YouTube gurus, and I've been on a bunch of these shows where it's like the world's going to end. And I'm like, well, where is that in the data? Because I certainly don't see it. If you want the best book on the housing crash, and I've read damn near all of them, this is it. It's Aaron Clarey's book, Behind the Housing Crash. And I'll tell you why this book is important. It really illustrates how much stuff had to happen in order for there to be a real estate crash. Now, I know a lot of you guys, I know you're headquartered there in Arizona. But I'll tell you, Arizona had a real estate crash. Arizona is one of the sand states. It was Arizona, Nevada, California, Florida. They lost 30, 40, 50% in what seemed like overnight. In Texas, we lost like 6%. We really didn't have a crash. I mean, there were investors running around screaming like their hair was on fire, but I'm like, there are people like in Florida that were legitimately bankrupt, right? I mean, it was just absolutely wild. But in any case, I highly recommend that book. So let me explain a little bit what's going on right now. And this is the most important chart. Actually, there's two of them here, but this is the most important chart in real estate. And let me explain what this is. The red line is number of new homes built. The green line is median new home sales price. So what happened in 2007, 2008 is we had a crash. And how houses get built in the United States is there's a real estate guy like me that'll go out, borrow some money from local or regional banks, buy a piece of dirt, move a bunch of dirt around and put in utilities and roads and water, sewer, all that stuff. And then we invite home builders to build on that property. That's when you get Lamar, Trendmaker, Pulte, all those guys, and they go and section off the neighborhood and they start building. So there's really no national developers. It's all done locally. And here's why this is important. Barney Frank and the guys, when they passed that banking legislation back in 08 and 09, one of the things they put in there is a limit on how much state, local, regional banks could lend for real estate development. And here's the problem. If there's no land that's being developed, then that means there's no houses being built. And the problem is that legislation is stuck right in the middle of that consumer protection law. So the likelihood of it ever being repealed is about zero. And that's what's caused this huge disconnect here. I mean, this chart goes all the way back to 1990, and prices and number of homes built kind of track along similarly. And then we have the crash. And what happens? Oh, now we're going to limit how much funding we're going to give for real estate development. And that's where you see this huge gap here. Apartments are a little bit different because typically somebody buys the land. Same guy that's buying the land is also building the apartment complex. So that's completely different. But in single family, the developer goes out and develops, and then they start selling homes. And it's somebody else that actually builds the home. So I heard from Keller Williams, Gary Keller said, if demand stays the same and construction stays the same, it will take 18 years of new home construction to meet demand. So we are just not building enough houses, and it's putting huge pricing pressures on existing homes. This is Mike Simonson. I am a huge fan of what Mike is doing over at Altos Research. And he does a podcast every single week on Monday. I highly recommend you watch it. So what's the problem? One of the problems we have is extremely limited inventory. In fact, we usually hover around 1.5–1 million homes for sale for the last, I don't know, 6, 7, 8 years. We are now well below under 1 million. I'm going to say we're 700,000–800,000. And that is causing massive pricing pressure. Now, at the peak of the housing crash, we were at 4 million homes. So when someone says, Jason, there's going to be this big real estate crash, I'm like, okay, well, where do we get 3.5 million homes from? Because they just don't pop up out of thin air. And I've got a bunch of foreclosure data and I can pull all that stuff up, but I don't have it in this presentation. I got it in my special file here on my desktop, but there's not enough foreclosures. In fact, I used to have this slide where there was 2 articles. One was the total number of houses in forbearance, which is about 4 million. And everybody assumed all 4 million of those homes were going to foreclosure. And then literally a different article, same newspaper, same day, said America is short 5 million homes. So we could literally drop 5 million homes into the market and bang, they'd be gone in a heartbeat. So I keep asking folks, I'm like, where do we get all this extra inventory? This should be if you guys have been in real estate for a while, you should pretty much know it's a seasonal business, meaning summertime's when we sell houses most of the time. And then starting the winter, it cools off a little bit. And you see this natural seasonality to the pricing data. And that's really all this is. Now everyone's freaking out because we haven't experienced this in the last 2 years where it's like, oh, wait a minute. What do you mean house prices go down in the winter? I'm like, well, that's kind of typical. It's called seasonality. And then prices went down a little bit and everybody freaked out like, oh, there's going to be a crash. I'm like, no, this is what it was like before COVID. We typically have two types of investors out there. We've got the active investors who are out finding deals and dealing with what I like to call the headaches. That's what I do. And then we've got passive investors who lend their capital to active investors and get some above average rate of return. I'm going to assume you guys all know that because you wouldn't be here if you didn't have some kind of idea of kind of what's going on. So let's talk about a couple of deals that I did here. In fact, some of these are almost done with construction. This is a big, I only buy, I should say it like this. I only buy big pieces of junk. Like even my apartment complexes are just absolutely atrocious. The last apartment complex we bought, I kid you not, I couldn't tell where one unit started and the other one ended. I mean, it was just an absolute disaster. So that's what we buy. We kind of specialize on that. If you really look at our business, we're a construction company. It's probably the best way to put it. So I bought this house. It was a single family house with 3 1-1s kind of all scattered around this plot of land. So I get a call from a friend of mine. He said, "Hey man, I got a house for $165,000 that's rented right now for $3,900 a month. Now it needs a lot of rehab." But he said, "Look, it's rented for $4,000 a month. Are you interested?" And I'm like, "Absolutely. Send the contract over immediately." He's like, "But the catch is you got to close in a week and a half." I'm like, "All right." So send an email out to the private lenders that I work with. A lot of them are clients of self-directed IRA companies. And I said, "Hey, who's got $165,000 to purchase the property and who's got another $78,000 to do the rehab?" So in about half a day, I had somebody said, "Yeah, I'll go do that deal with you." So we bought the property. We're actually starting a rehab right now. I don't want to say we evicted the tenants, but we had to evict the last one. We essentially said, "Hey guys, we need all y'all to move out, then we'll rehab it, and then we'll open it back up for rent." And we've got a couple of different options. We could have actually kept it as is, or we could actually go out, rehab it, and then rent it. So we have a couple of different options. What I decided to do is take this property, instead of making it a 4-unit, if you will, it's going to be a larger house and a 3-1 in the back. So it's going to be 2 units instead of 4. And then we just get higher rents that way and a handful of other good things. But in any case, that's that particular deal. This is one of my first land deals, and I don't do very much new construction, go out there and buy a piece of land and then put a house on it. What I do like to do is buy a large plot of property that maybe has a house on it. And then I rehab the house, and the house renovation, once it's all completed, covers the value of all the land. So essentially I'm getting the land for free. So I bought this particular house for $75,000. I put $75K in rehab, did about it pulls in about $20,000 a year in gross rents. In fact, this one starts in another 2 weeks. We had just closed this one about a month ago. We're going through the permitting process, and I'll show you what we're doing here in a minute. So about $35,000 in equity, but not a huge like home run deal, but a pretty decent little deal. Brings in like $1,000 a year. I mean, rates are like 8%, right? So not super, incredible deal. But this is actually a picture of it. But this is the interesting thing.
That is a nice one.
It's actually, this one's actually not bad. The roof looks good. So any seasoned investor can already see it. They're like, if the roof looks good, the foundation's usually good. And you can see we got new electrical service in the back. So it's actually not, it's just a little torn up on the inside, right? And the outside.
Hey, Jason, I just want to say something too. For you self-directed IRA investors, I get this a lot with people that are hesitant to buy their first deal. And by no means am I telling you to rush on your first deal. That's not what this is meant for. But people always try to find the home run deal. They try to find the deal that's just perfect and checks all the boxes. Well, guess what? That's also going to be the hardest deal, because you're going to have other investors that are like cramming for that deal too. But Jason mentioned something. This is a base hit. And I always revert that back to my baseball days. Couple base hits score runs too. You don't have to hit home runs to score runs. So, something that I like about Jason, what Jason's talking about here is, get a couple base hits, get a couple doubles. That's just as good as hitting one home run.
Nate, you'll love this. I heard this stat the other day as a baseball guy. Somebody had said the difference between the Mendoza line and the Hall of Fame is 7 hits a month. Yeah. It blew me away. 7 hits a month. That's it.
Yep.
That's it. Like, people don't realize, like, you gotta be out there. You gotta be doing it. There's always gonna be more money. There's always gonna be better deals. It's just sitting around waiting. It's just, that doesn't really work. It doesn't work in any human endeavor.
Well, and I'll say this too, just especially today, and you can chime in on this too, but today, right now, cash, if you have cash sitting in the bank, you're losing money. You're just getting broke safely. You just don't see it, because the value of the dollar is decreasing, and with all the bank stuff going around, it behooves you, I would say, to have your money, whether it's IRA money or not, into something that's income producing, whether that's a real estate, whether that's a note, whether that's a syndication deal, something that's in, where your cash is invested in something tangible that has either multiple income streams or some appreciation. But just leaving cash on the sidelines is probably not what's going to get you to a comfortable retirement.
Well, and I'll tell you guys right now, you can go to the Chapwood Index and you can type in your city and it will show you what your rate of inflation is in your town. And people think like, oh, it was just recently that it was 2% inflation. I'm like, no, it's been 6 or 8% in Houston for like a decade. So if you just type in, it's called the Chapwood Index, and it's a very popular inflation metric. Type in your city and you'll see what that cost of inflation is. Yeah, the money, the joke one of my business partners, Brian, and I have is like, we can't get the cash out fast enough. Like it comes back from a deal, we send it right back out. It's like, get it, keep it moving. Yeah. So in any case, back to this deal. So you can see the house there. This is actually the house here, and it's 1.5 acres. So we're working with the city right now to rezone these lots. In fact, we originally had 5. I think we can fit 6 on there. If we do this little, we got to kind of give this little easement up and do a couple other things. But in any case, so it's going to cost me about $12,000 to subdivide this thing. So that gives me a whole host of options. This particular property is actually in Corpus Christi, which, if you guys don't know Texas, that's like the second most popular vacation spot in the state. It's a pretty popular place. San Antonio being the first. Option 1, we can rehab and rent a short or long-term rental. We can demolish the existing lot or existing house and then subdivide all the lots and sell them, renovate the house and add additional houses and rent as short or long-term rentals. We can demolish the existing house, build houses as short or long-term rentals, or demolish the existing house, build houses, and then sell retail. So we've got a lot of options here. What the current business plan I picked is, we're going to subdivide it, and then we're going to build 5 more properties on those subdivided lots. Now, some people ask me, well, Jason, why don't you just throw a bunch of houses up there? And I said, well, here's the problem with doing that. When you do that, it makes the financing really difficult. Financing single family is really, really easy. So if I just take it and subdivide it into 5 little lots, I have 5 different addresses. So I got 5 different projects and I have 5 different loans, and it's really easy to finance. When you start getting into the small commercial stuff, it starts to become a real challenge. So this is one of my favorite deals here. I closed on this one, I think 2 weeks ago. This is what I'm calling the long-term flip. This is the picture from Google Earth. The cops showing up, and I don't know what they're doing, arresting somebody. I don't know what's going on. But if you look on Google Earth and you like rotate it side to side, literally there's like 5 more cop cars down the street. So pretty neat little house. This is actually what it looks like today, before the rehab. But this is pretty standard for what we buy. It needs foundation, HVAC, needs, electrical, needs a whole thing. Buying it for $100,000. By the way, that is a foreclosure. We are starting to see some foreclosures finally hit the market. I think the reason we haven't seen them is because courts have been closed, and they're just starting to catch up with all the COVID stuff. So bought it for $100,000.
And Jason, I actually have some, for the listeners, I have some foreclosure data. When you're done, I've got some foreclosure data that'll help people too. So go ahead. Sorry.
So bought the house for $100,000. Rehab's going to be about $97,000. And ARV is $300,000. So it's got $100,000 in equity. Now, the old version of me would have said, well, let's flip it, make our quick $100,000 and move on to the next deal. The problem is that when you start making some pretty good money, you really hate paying taxes. So what I'm going to do instead is rent it. I'm going to rent it for about $1,900 a month. I got insurance, taxes. I have property management, and that's my mortgage down there. It's going to be negative $60 a month in cash flow. I get investors all the time that tell me, Jason, I would never buy a negative equity or negative cash flow deal. And I'm like, would you do that if it was, let's say, negative $1,200 a year, but you had $100,000 in equity? Like, oh, I would do that. And I'm like, okay. So here's a perfect example of that, where I buy them occasionally. They're negative cash flow, but I don't care, because I got $100,000 in equity. By the way, this market's appreciating 25% a year. So I'm going to pick up another $60,000 in equity next year. So I'm probably going to cash out $160,000 when I go to sell this particular property. like I said, yeah, it's appreciating about 25% a year. So not a bad little deal. So let me show you guys real quick, because the point of this webinar was a little bit of how to pick markets and all that stuff. So we are actively using Chat GPT in our business, in multiple facets of our business. In fact, I had a conversation with one of the guys in our mastermind group yesterday. He is a retired developer from HP, and he said, "Hey, Jason, we ought to look at maybe building some prop tech company around this technology." I was like, "All right, well, it's worth having the conversation."
And
So
Jason, tell people what Chat GPT is. If people don't know what it is, tell them what that is.
Yeah, so Chat GPT is an artificial intelligence, and the way it works now is you give it a question, and it will give you the answer. And it's not like searching on Google. It's kind of taking that to the next level. So what it's great for is it gets you 50 to 75% of what you need. Then you can take out these small pieces and then go research them. If that makes sense. So I'll give you a great example. I asked ChatGPT, I said, "Hey, what are the fastest appreciating single family zip codes in the United States?" Now, I could type that into Google. I'd have to read 15 articles and figure, because they're all going to be a little bit different. What year, what's considered appreciate, all that stuff. ChatGPT just kicks this back to me in like 2 seconds. And it says, this zip code for Beverly Hills, New York, Miami Beach, Atherton, California, and another New York zip code. The problem is these are really expensive markets. So do they those are the ones that appreciated the most. It's fantastic, but I'm not buying a $4 million house in Beverly Hills. So then I asked ChatGPT, I said, "Hey, for the houses priced below 200 grand, what are the fastest appreciating single family zip codes in the United States?" 2 seconds later, it punches this out. Here they are. This zip code in Las Vegas, here, this zip in San Antonio, Tampa, Austin, and here's another zip in Las Vegas. Like, oh, okay, well, that's kind of good to know. So then I asked it this. I said, for houses priced below 200 grand, what are the fastest appreciating single family zip codes in Houston? You've got to remember this. I'm putting these questions in. It is immediately firing out. So this is like me playing with this for like 3 minutes and just how fast the information comes back to you. So here's a crazy thing. It says in Houston, Texas, here are the fastest appreciating zip codes below $200,000. So then what I did is I took Friendswood 77546, and I went over here and I got into our local MLS, which is, oh, here it is. Hold on a second, guys. Sorry, the little Zoom bar is right in the way. Okay. Damn it.
Oh, you're fine. Tristan, see if we have some questions while he's doing that.
All right, here we go. So then I typed in 77546. We got 177 listings in there. So I just pulled it up real quick. And then I sorted by, in other words, the cheapest stuff first, the ascending properties first, because I'm looking at the properties below 200 grand. In fact, in here in smart filters, you could actually do this and put in, below 200,000 bucks. But this is what I did instead. I just wanted to look at what's going on in this marketplace. All right, this is a piece of land. Okay, who cares? So let's go down here. Interesting. Okay, condo, townhome condo, townhome condo. Then we get to the single family, 249. This thing's been on the market 39 days, not moving real quick. Then I notice 8 days. So under contract in 8 days, under contract in 8 days, under contract in 3 days, 7 days, 5 days, 3 days, 47 days. It's probably when priced right. This one's been on market 23 days, 120. But you start to see the trend here. And that is, I can easily go to ChatGPT. I can pick out whatever markets I want in whatever city. I can ask it what zip codes. ChatGPT looks at historical data. In fact, I think it's up to 2021 because the problem is the AI is so powerful. It can actually predict what happens in the stock market. I mean, it could do some really crazy stuff. So the data is only current to 2021. However, the important thing for you guys is figure out more markets you want to be in, do a little research on ChatGPT, and then go to your local MLS, type that zip code in, and you don't have to have access as a realtor to do this. This is the public facing side of HAR, even though I think I'm not even signed in on this one. So then you can easily go through, hey, let's see what's pending. If there's a bunch of stuff that's pending in less than a week, what's that tell you? It's still an appreciating market, and it's a fantastic market to invest in. So that's what I got.
No, that's phenomenal. And, to be honest, we've started using Chat GPT on some of our marketing stuff, and it's phenomenal how fast it will kick back an answer to you. And it's written scripts for us for our marketing. I mean, it is a phenomenal tool, and I think it's only going to get better. And that is amazing how it spits out that information to you guys. So if you guys are interested in, really dissecting, if you want to stay local, well, use Chat GPT, find out what local zip codes are the ones that are appreciating the fastest.
So I just typed in, Nate, how do you
Yeah.
invest with a self-directed IRA? 2 seconds, bang,
Oh, yeah.
here's your steps.
Yeah, exactly.
It's
There's the
amazing.
steps. Yeah, there are the steps. Tristan, let me show my screen real quick. I got a couple slides I want to
let me
just
see.
add. That'll be good. And then we'll take some questions for you guys. If you guys are interested in some more data, I'm a data guy. I know Jason's a data guy. I like to follow auction.com. I've had some personal experience with auction.com. If you guys don't know who auction.com is, they're owned 50% by Google. They're a behemoth when it comes to REOs and auction property, both live auctions and online auctions. But they spit out a lot of data based on the behaviors of auction buyers right now. And this is kind of a chart that I pulled up recently from Darren Blomquist. He's one of their VPs, VP of economics there at auction.com. And one of the interesting things when you look at this chart, you see a lot of red. I would say beginning investors probably get scared of red. Experienced investors, chime in on this, Jason, but they get excited when they see red sometimes. And
absolutely.
And even Darren himself, who posted this, said, the red market areas are where there may be opportunity to buy distressed property at deeper discounts. And those red areas, by the way, those are the areas that they anticipate there being more risk of price drops and a sharp decline if we see a decline. But at the same time, those sharp declines are the ones that are the fastest to rebound too. So in those red areas, again, if you're a real estate investor, it doesn't mean that it's bad. It means those are some of the areas of opportunity that you might be able to buy some single family property or other property at deep discounts. But even the green and the blue areas, they might not feel the effects of some sort of pullback on appreciation as much, but you're going to have a little bit more upside. It's going to be a little bit more stable. Whatever type of investor that you're trying to be, I think there's areas of opportunity there. And this is straight from auction.com, and they sell about $50 billion worth of real estate. So the data is pretty good to know. And I learned this trick way back when I started investing in real estate. Somebody that I look up to a lot who invests out of state. Again, just another trick that you guys can use if you're interested in where you see some opportunities in another state or another city that you want to investigate. Is you don't have to do all the research yourself. Sometimes it's great to have Chat GPT, but back in the day, we didn't have Chat GPT. But you could just follow companies like billion-dollar company U-Haul. U-Haul does an amazing amount of research to figure out their prices on U-Haul rentals. They know where people are moving. So I just pulled this up just to give some comparison. I pulled up a U-Haul rates for moving to San Francisco to Houston and back. A 10-foot truck going from San Francisco to Houston is going to cost you $2,700. The same U-Haul going from Houston to San Francisco is going to cost you $1,500. Okay. Why is that? Same distance. They're telling you where people are moving. They're going to charge you more to take that truck to Houston because people are moving there. They're going to charge you less to come to San Francisco because they need the truck back. So again, there's so many unique. The thing I like about this is there's so much data and there's so much area for people to get information nowadays. It makes it easier, I would say, Jason, for people to invest in their state, outside of their state, because there's just so much data that you can get at the drop of a hat.
Yeah, absolutely. And I would, for those folks that like to invest out of state, we're going to build a handful of these real estate investment centers across the country. The first one we want to put is actually in Vegas. Like that's the first one out of state, but I'm going to have to learn, all the real estate laws in Nevada. And I'm sure it's a little bit, I get asked all the time, do you invest in Louisiana? Cause it's right down the, literally you can throw a rock and damn near hit Louisiana from Houston. And I'm like, I would, but I got to learn a whole new set of real estate laws. So what I tell a lot of folks is if you're going to invest out of state, pick maybe one or two states, because you're going to have to kind of figure out every state's just a little bit different. But and it's all a click away online, or talk to a real estate attorney in one of those markets. You can get up to speed pretty quick.
Yeah. Tristan, we have any questions? The audience out there? Okay, if you guys have questions, type them in. We'll take them now. If people have questions for you, Jason, what's the best place to reach you?
Jason at mrtxre.com.
And that's Mr. Texas Real Estate.
That's Mr. Texas Real Estate.
Yep.
And if you guys are interested, I do these webinars once a week. They're a lot more market driven, so a lot more data. But every single week on Monday at 11 o'clock Central, I'm doing a market update. And a lot of it's national data. It's not all just Texas and Houston, but it's like you guys can follow along there. We're on YouTube and LinkedIn and all those other places. So
yeah, I personally follow Jason. I would highly recommend follow Jason, follow the people that he also mentioned to. Again, it's just going to make you a better, more informed investor. And, you know, I can vouch for Jason. I know back when he was talking about, you know, if you think real estate is expensive now, just wait. And it came true. And I think you've said this a lot too. The best time to buy real estate was yesterday. Pretty sure you coined that term.
Yeah, it was yesterday, and second best time is like right now.
Right. So I would say there's always areas of opportunity, regardless of, you know, what cycle we're in. That's one thing that I've learned about real estate is that it is cyclical, but there's always, when you're in different cycles, different strategies become more, you know, prevalent. Do you want to speak to that? Or are there different strategies that you look at depending on where we're at in the market?
I'll tell you right now, what is crazy is, and I had Rob, my business partner, called a bunch of the hard money lenders here in town, or at least the big ones. And they said, hey, what are most of your clients buying? And I mean, some of these guys have 200 million on the street, I mean, big companies, right? And every one of them said very few flips. Everyone's doing rentals right now. So what that told me is we need to start flipping houses. We need to go buy houses in that flip price point. So I just went on a tear in the Heights. I already got one. I closed on it yesterday. I'm about to buy. I got tons of offers out. And I think we're about to snag 3 more. So somebody will ask me, well, Jason, why would you buy, you know, it's an $800,000 house you're buying for 400 grand. You're putting 150 into it. Right. And I'm like, look, it might not even cash flow. It might be negative cash flow, but I'm not buying it to sell it today. I'm going to sell it a year or 2 from now when interest rates are half, and that's now $1 million home, and I'm in it for 600 grand. Like that's the strategy. I look wherever all the investors are running from. I go, okay, well, what are we running from? Oh, they're scared they can't sell it in a high interest rate environment. Okay, so what does that mean? There's still market demand, if you will, to sell distressed houses, even the higher priced ones. There's just not as many investors in that marketplace right now because they're scared they can't sell them. So I'm like, well, I'm going to go buy as many as I can. I'll just rent them or Airbnb them for a year or 2, and then just turn around and sell them. Then we'll take our money and move on to the next one. Yeah.
Well, and you know, I don't want to forget, you know, you led off with something that was real important. And I've even heard this from, you know, being in the loan business. You know, I'm still a licensed loan officer, and I follow a guy named Barry Habib, who's kind of the mortgage god, if you would. And he's always having, you know, predictions about the market, but he said the same thing. He said, you know, people are hesitant to buy real estate right now just because interest rates are high. But the problem is that inventory is still low. So there's not a lot of homes on the market. But if we start to see a decrease in interest rates, the market's going to go on fire because you still have the inventory problem.
Our prediction is 5.5%. We hit 5.5%, and it's going to look like COVID all over again. And it's going to last for years because we have way too few homes on the marketplace. Now, most home buyers are also home sellers. So we'll start to see that natural churn and inventory will pick up, but it's going to be rough, and a bunch of investors are going to try and get in, and they're just going to get hammered with competition. Like it's going to be absolutely wild, just wild. We hit that 5.5%. That's why I tell everybody, I'm like, look, back in 2019, if you paid retail, if you bought 12 houses for $185,000 each, you had 12 of them, did nothing to them. Today, you'd have $1 million in equity. So I'm like, you guys can wait, but it's going to cost you. And I looked at our local MLS. Our local MLS is down 2%. Median home price is down 2%. But I look at the houses that I'm mostly buying, and vast majority of my portfolio is 350 grand and below. So I pulled the data out. Those are up 8%.
Yeah.
So
it's crazy.
It's absolutely crazy.
Yeah. Yeah, I mean, prices are still going up in some areas, so people are saying, "Where's this decline?" But again, it's that underlying, it's that shortage of inventory that's going to keep prices at least where they're at. I mean, we might see some declines, but it won't. I don't think, in my opinion, this is just my opinion, it's not going to last. It's not going to be anything like a crash, nothing like that. But it may steady out. But again, for self-directed IRA investors, remember, you're not thinking about interest rates in most cases. If you're buying a house all cash with your retirement funds, you're not worried about high interest rates at that point. And right now, because interest rates are where they're at, you have sellers that are giving more back to the buyers with credits towards closing costs, buy downs if you are using a lender. But there's a lot of different, avenues you can go to get, to seller to pay for things that you don't get in a market that's the other way around.
Yeah, you've got a little bit of leverage right now. And I'll tell you, we're working with a lot of asset managers because their foreclosures are finally hitting the books. And they just don't really want to deal with a lot of unprofessional small-time investors, probably a good way to put it. So a lot of times, especially in some of the marketplaces we're in, we'll get a call and go, all right, guys, now they have to go through their process, right? They go through the foreclosure, they got to list it on MLS, but their agent will now reach out directly to us and go, hey guys, I got these 6 listings coming up. What do you guys want to do? And we'll go, well, let's go look at them, then we'll make offers. Now, depending on what the bank's policy is, maybe they have to be on the market 5 days or 15 or whatever, 20 days, whatever it is. But they literally already have a contract from us with a price on it. And they go, okay, if there's no other offers, you guys are going to take it. So you're able to get away with some stuff right now that you couldn't come close to a year ago. I mean, it is really something to see.
Let me ask you this, Jason. What types of deals are you staying away from? Now, I know you're an aggressive guy. You like to buy it, but there's got to be some deals or some niche that you stay away from. What are the ones you stay away from?
So right now, just because the financing is a nightmare, and that is small commercial real estate. So we own like our office building. I own a bunch of small apartment complexes. All of them are less than 50 units each. And we're refinancing some right now. And we're getting it done, but it is tough. There is one lender out there. Most of these apartments are the small ones anyways, are financed by local and regional banks. And since the banking crisis started, they're just really not lending right now. And which is funny because like we've got lines of credit, right? We buy a lot of stuff with lines of credit, and we're going to our bank partners and going, hey, we need some more money. And they're like, well, we're really kind of, drawn back because this. I'm like, no, we're a good risk. We're making you money, but it doesn't matter, right? Because they're just also scared. So right now, the small commercial stuff, we're doing like the next one we do is going to be 100% equity raise because we know we know it's there. Like it's there. Like we know this is a good deal. It's just the financing market's real goofy right now. So, in a year from now, that might not be the case.
Yeah.
But the problem is a year from now, that apartment complex is now worth $25,000 more a door. So you got a choice. You can have an easy financing market or pay more for it. It's kind of 6 of one, half a dozen another. So
yeah, makes a lot of sense. I'll start wrapping up here. And again, if you guys have questions, for Jason, email him directly. He shot out his email. I've got my email toward the end here.
Nate, I do have one question for you.
Yeah, go ahead, Tristan.
So someone asked, they have a self-directed IRA and a conventional solo 401k. They're asking, can they roll over that solo 401k to a self-directed Roth? Would that be my best option? Will I have to pay taxes? Is there a way of avoiding it?
Mm-hmm. So if you have a solo 401k now and it's traditional money, meaning it's pre-tax in there, the first thing I would do is just check your plan documents for the solo 401k. Most solo 401ks, I know ours usually allows for it, but they allow for in-plan conversions, meaning you can just convert what's in there pre-tax in the 401k and just convert it to Roth 401k money. You don't have to take money out. One thing that I do want to mention, though, when you're talking about IRAs and 401ks, one thing, especially for small business owners, the ones that are using that solo 401k, which is a phenomenal tool when you're buying real estate, because there's an exemption to unrelated business income tax. You have the checkbook, you can write checks, you can buy and sell real estate really, really fast when you have a solo 401k. And by the way, we set those up for you. And you can roll traditional IRAs into your solo 401k. The weird thing about the rules that they haven't changed yet, and it doesn't really make much sense, but the rules are the rules. You can't roll Roth IRAs into a solo 401k. You can roll traditional in. So the one thing I would be cautious of is moving money out of that 401k just to convert, because once you convert, you can't put it back in. So first check with your solo 401k plan documents and see if it'll allow for in-plan conversions. You can just do the conversion right in the plan. Cool. Any other questions, Tristan? All right. If you guys did miss anything, we've got 2 YouTube channels now. We've got the Matt Sorensen channel, but we also have our own YouTube channel. If you look up Directed IRA Workshop, you'll find where we're starting to upload some videos. We've got our first 2 workshops on there. We'll upload this one. We're going to upload every single workshop that we film and record on there. We're also in the progress of filming some how-to videos, some tutorial videos, some resource videos. So that's going to be the #1 source for self-directed IRA information, is that new YouTube channel we got. So just try to subscribe and check us out there. Again, look up Directed IRA Workshop and you'll find that YouTube channel. And anybody who watches this program, anybody who attends, this is my own special promo code. If you guys want to open self-directed IRAs, whether that's traditional or Roth or solo 401ks or self-directed HSAs, use the promo code RYR100. That's Rethinking Your Retirement 100. It gets you $100 off every single account you open. And that's a credit towards your first year's fees. And by the way, we're probably one of the least expensive self-directed IRA custodians. We really shouldn't be, because if you look at our Google rating, we're 4.9. We're the highest rated for customer service and processing times, but our fees are really a bargain. So we only charge based on the account itself. We don't charge you based on the number of assets you hold in the account. We don't charge based on the value of those assets. It's just a flat $295 a year for the one account, and we give you $100 off, for that account. So really, you're only paying $195 plus some processing fees if you're interested in self-directing your retirement. And just reach out to me if you want to talk about that. And there's my information. There's my email address. There's my phone number. And if you scan that QR code, you can book an appointment directly with me if you want to talk a little bit about strategy. I can't tell you what to invest in. I can't give you tax or legal or investment advice, but I love talking about self-directed IRAs, the process of setting them up, and the different strategies that you can use when it comes to buying real estate and other non-traditional investments. So thank you guys. Thank you guys for joining us. Jason, it was phenomenal, man. You shared some great information. Any last piece of advice you want to give our viewers?
Yeah, go out and buy some real estate. It's about to get expensive again.
Oh, man, I appreciate that. Check out Jason. Make sure that you guys follow his podcast and all the things that he does. And again, thank you, Dallin Schultz with Rev Equity Group. You guys do a phenomenal job for our investors here. So make sure you check out them and their new website and sign up for that 15-minute consultation, see if what they've got is right for you guys. And stay tuned. We've got 2 weeks from now, May 17th, I believe. Is that right, Tristan? Is our next workshop. We're going to have a special guest, another friend of mine, Jason Matthews, who's going to talk about short-term rentals and Airbnbs in your self-directed retirement account. And he does a phenomenal presentation where he talks about all the things he does with his Airbnbs to make them more profitable. And I get the question all the time, Nate, can I buy short-term rentals in an IRA? Yes, you just can't buy life insurance and collectibles, but you can buy short-term rentals. You can Airbnb them, and all that profit usually is tax-free. But there are some caveats with short-term rentals. So if you want to know how to buy effectively short-term rentals in a self-directed IRA, make sure you register for that workshop coming up in 2 weeks. So thank you guys. Have a good rest of your Wednesday. This was Nate Hare with Rethinking Your Retirement.